What's going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. Oop, I just whistled there. Hopefully, not too annoying for you in the microphone. My name is Alex Ivanovich. I am going to be hosting today's episode just like every other episode. We've got a lot to talk about. I fielded a few questions from this week. I chose the top 5 questions we're going to go through in a lot of detail on this episode today. I'm looking forward to it. I hope you are too. So, without further ado, let's jump right in. So, question number 1 says, at what point is it prudent to buy big tech stocks or the Nasdaq in general? I guess they mean the QQQ. I thought about it this week with the market looking cheap. Oh, the market looking cheap. Well, I wish I could reach out to our viewer and say, by what metric do you think this market is cheap? I mean, compared to the last few weeks, sure, it's the cheapest it's been because we had a few days of bad price action. I want to say the NASDAQ or the Qs were at 565 roughly. I can't remember what the exact low was, but that 560 to 565 range. And let me be clear, that's about the price that we were at. Off the top of my head, I want to say 6 months ago, maybe 7 months ago. And I don't know what metric, when you say cheap, what metric are you referring to? I don't think it's necessarily cheap on a price to earnings basis. Sure, there are some big tech stocks that have had really deep sell-offs, and I would argue that maybe they are attractive at these levels. We've obviously talked about Microsoft in great detail on this podcast, and I would say that Microsoft, if you were just strictly looking from a valuation perspective, I don't know from a flows perspective, there's not a lot of love for that group right now, software. There are concerns revolving around private credit and private equity in software. If those concerns were to grow, it might have a bit of a spillover effect or contagion effect that impacted Microsoft as well. I'm just focusing on Microsoft because when I think of big tech stocks, the ones that we typically think about, Meta, Nvidia, Tesla, I think you could consider Tesla a tech stock. Google, Apple, Microsoft. Microsoft is obviously these magnificent 7 names. Microsoft has obviously seen the biggest sell off of all of them. So I want this viewer, whoever asked this question, to text back in and let me know what metric they're referring to when they say the market looks cheap. I don't think the NASDAQ is buyable here. And I said I can't remember if it was last week's episode or the week before. I think it was 2 weeks ago now. Given all the risks in this tape, and we're still really not out of the woods yet on this whole Middle East situation, I don't think a NASDAQ pricing in the same multiple that we priced in 7 months ago is very attractive right now when you compare the 2 periods, the 2 points in time. 7 months ago, you had basically none of these risks. No one was talking about private credit yet. No one was talking about AI, slow down, none of that. There wasn't any real consumer concerns yet. And now you have so many more things, so many more overhangs, a storm brewing on top of this market, and you want to pay the same multiple that you did back then. It doesn't make a whole lot of sense to me. So, for that reason and many more, I don't think this market is cheap. I don't think you can just start buying the Qs all willy-nilly. So moving on to question number 2, what is your read on the consumer? I saw RH and Nike trade pretty sloppy on Wednesday. So Nike did trade pretty bad. I think closed out on lows, at least the last 15, 20 minutes of the day that I was watching, it was at or near lows. RH, I want to correct this person. RH had a nice bounce after the initial low that it made about an hour or two after the open. So yes, obviously, both more consumer discretionary, consumer spending exposed stocks. I don't want to make a definitive call right now based on 2 earnings reports. I don't think that would be very prudent or intelligent of me to do or say. What I will say is if you take a look at charge-offs, credit card delinquencies, and you focus on not really your traditional banks, but consumer lending platforms, i.e., stocks like SoFi, PayPal, buy now, pay later exposed stocks like Affirm, take a look at the price action year to date in those names, and you'll start to see what people think of the average consumer, right? These are stocks that are heavily exposed to consumer lending, and delinquencies have been on the rise. And I think anyone with half of a brain would tell you right now that affordability in the US is anything but affordable. Gas is about to be more expensive than it has been in the last few years. We still haven't hit the 2% inflation target. That's the Fed's stated goal. Unemployment hasn't really cooled off. And let me be clear, it hasn't spiked or anything, but it hasn't cooled off whatsoever. We've stayed a little bit flat. Sentiment is low. If you look at PPI, CPI, whatever inflation metrics you look at, they're all slowly on the rise. And I think this next wave next month of inflation readings that you get, we just saw inflation readings from Germany a few days ago where there was a massive spike in all the readings month over month. And we're going to start to get more readings in the next few weeks. And I think you'll start to see some of these bottlenecks that have been caused by what's going on in the Middle East start to show up. You don't really need to look at Nike and RH to think, oh no, what's going on with the consumer? I think you've had a plethora of data points in the last year telling you exactly where the consumer is, and they're on average, I think, struggling. So that's my answer for that question. And I would also say the prospects for things to look up or improve is not very great at this point in time. So let's move on to question number 3. When markets are this choppy and I haven't traded in a while, I'm really starting to feel the itch to do something. Do you ever get that? I think anyone that loves trading or loves investing or loves watching the market or just anything to do with the stock market in general or financial markets really, yeah, you get the itch every now and then. Like you want to do something, you want to be active, you want to make some money. You have to be aware, be cognizant of that feeling. I don't think you're a bad person or a bad trader or a bad investor if you feel that feeling. We all do. We're all human. I think it's natural to feel that allure to go and make money. Your brain can fool you into there being 1,000 opportunities to make money every day. If you selectively cherry pick things from the market, for sure. When you feel that itch, though, I would say before you put on any trade, ask, have you seen this before? Is this part of your model? And don't just run into something because the setup sort of looks good. Because you can be subjective and say that any setup looks good after 10 days of no trading just because you want to put something on and feel a little bit of risk. If you do that frequently, I mean, if you do it once on a blue moon every now and then, and it's because you haven't traded in 2 months or there hasn't been anything to do, I get it. We all fall victim to that at some point. And the minute you realize that you've done it, the best thing to do, whether it's a winner or a loser, get the heck out as soon as you can before it turns into something that you can't manage anymore. If you find yourself doing that more than once on a blue moon and you're doing it multiple times a month or even multiple times a week because you can't stand the fact that you can't trade, or maybe there hasn't been a good idea for a few hours, let alone a few months, I would take a step away and really evaluate your tendency to be a gambler. I'm not calling anyone out. I'm not saying anyone has a gambling addiction. I'm just saying that is the behavior that somebody who has a propensity to gamble a lot would exhibit. And I would implore you to please explore that feeling a little bit before you go out into the market. If you're feeling the itch every now and then, like I said, that's totally normal. We're all human, but that's completely different from feeling it every day because you haven't had a trade in a few hours. Question number 4. I thought for sure HMH, or was it MHM? I can't remember. That was that big oil IPO this week. I really can't remember the ticker. I remember I kept typing it up and messing up the ticker symbol. It was either MHM or HMH. I think it was MHM though. I thought for sure that company would open well. What the bleep is going on? Uh, it is an oil company too. So I think what they're referring to is, and I've said this before in the podcast as well, when you have a group that's performed really well and then you have a stock within that group about to do an IPO, especially if the market's moving in generally the right direction, there hasn't been a whole lot of headwinds, things are hunky-dory, going great. I can't think of an exact example at this moment, but there were a few times in the past I remember where I was talking to my mentor, there was an IPO coming, I said we should participate in the deal, that's a hot sector right now. Now, you would think with this IPO today that was led by JP Morgan, with oil at the price that it is, you'd think a stock like that, who's heavily exposed to oil, owned half by Baker Hughes, I think, would perform very well in its IPO day. So they priced it in the middle of the range. I want to say the range was 19 to 22. Don't quote me on that. It might be 19 to 21. They priced it roughly in the middle at 20. Stock opens at 18 and a half. Yet another deal, massive deal that we can't get any premium on the first day. And I don't think this speaks to the group. It does speak to investor demand for IPOs. I don't think there's a lot of demand for anything coming to market right now. And something that I keep on reading is this avalanche of IPOs coming later in the year. There's whispers of SpaceX. There's whispers of not whispers. They're shouting from the mountaintops on OpenAI. let's not kid ourselves here. There are so many tech IPOs that are coming later in the year. I think people might be just a little bit overwhelmed with the sheer dollar amount of deal flow that is coming. And then you add on top of that that the market has been extremely shaky. This little bid that we've had the last 2 days since Trump said that, things are going well in the Middle East and Iran might want to come to the table and discuss a ceasefire. I don't think there's really much more to say on this than this tape is not conducive to new issues right now. And this was just the latest example. If you go back to other podcast episodes that we've done and other short form videos that we've done on the TikTok and the Instagram and YouTube, you'll see that I've spoke about many other deals in the last few months that opened broken as well. I think off the top of my head, if there was 13 deals so far in 2025, 13 big ticket deals, not counting SPACs or any of that other nonsense, I think only 2 or 3 of them opened with any sort of premium. Now compare that with 2024, 2025, and how much premium a lot of the deals opened up with. Almost every single deal opened with premium. It's a pretty stark contrast. Well, folks, there you have it. That concludes all the questions that we have for today. I tried to choose the best ones, the one that maybe would encourage the best answers out of me, and maybe encourage some comments from you to leave in the comment section on YouTube. Make sure to check out all of our short form content on TikTok, on the YouTube Shorts, and on Instagram. That Makes Zero Sense is the name of all of the accounts, so make sure to go check that out. Thank you so much for tuning in to another episode of That Makes Zero Sense, the podcast. I'm Alex Ivanovich. I hope you have a fantastic Friday and a great weekend. Take care, and I'll catch you on the next episode. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.